Good afternoon and welcome to the CC Japan Income and Growth Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Portfolio Manager, Richard Aston. Good afternoon, sir.
Thank you, and good afternoon, everyone. Maybe I'll just start with a brief introduction to Chikara. We are a London-based boutique asset manager focusing on particular markets where we believe we can identify opportunities for delivering alpha, namely Japan and India. In both cases, we have long track records and have developed strategies that we believe are consistent with the opportunities that exist in both of those markets and are very much focused on long-term returns. The Japan team, I can highlight here. You see three members of the team. We are based in London. Our bios in detail are included, but I think the key from those is the fact that we have a lot of experience in Japan. I've been covering Japanese equity markets for 28 years. Megumi for more than 20, and Theo for almost 10 years. So a lot of experience on Japan. We work very, very closely, however, with research houses based in Japan that provide detailed and bespoke research on our behalf. So we don't underestimate the importance of working closely with companies, and we have access to companies regularly through independent research, but also we meet companies very regularly as they come through London, where we have the opportunity to meet senior management, but also each of the team travels to Japan on a regular basis to meet companies in their own offices. The trust was launched just about 10 years ago, reflecting the opportunities that we believe became particularly relevant about that time when looking at Japan, and felt that it was an appropriate vehicle. The investment trust was an appropriate vehicle to benefit from those, using some of the particular attributes that are available to investment trusts, such as gearing. But why this particular strategy? Well, I think it's very importantly, it's one that has been developed for Japan as it is today. So anyone with an extended memory of Japanese equity markets going back to maybe the late 80s is very, very familiar with markets that were really trending downwards primarily, but were also very, very difficult to invest in because they were very stylistic. We believe that the market dynamics changed quite notably, and that created an opportunity for us to invest in Japan in a way that was very, very relevant for the market as it was and as it is, and also created the opportunity for investors to benefit from long-term investment approach rather than really considering Japan for nothing more than a short-term trade. We particularly believe that long-term active approach is the correct one. We run a concentrated portfolio. We believe that there are opportunities right across the market cap spectrum, and build portfolios that reflect those views. As I mentioned, we benefit from, in the case of the trust, the opportunities to use the structure of an investment trust. For us, the most important, I think, is the ability to gear. We are not looking to time the market with this. This is a structural position which we think benefits both in the short term from enhancing the income that we're able to generate from the underlying holdings, but also in the long run from the capital growth that these companies have been able to deliver. And the final point, I think we spend a lot of time when talking about this strategy, is just emphasizing the fact that we are seeking particular attributes in each and every holding. So we're not a combination of growth stocks balanced with a portfolio of income generating value stocks. I think sometimes maybe people's exposure or experience in the UK with income-generating stocks maybe sort of taints the view. Actually, because of the unique position of companies in Japan at the moment, we feel that they are able to offer all of the attributes that we look for. So companies that can grow substantially over the long run, companies that have the financial resources to reinvest to capture that growth, but are able to sort of complement that with a steady and rising return to shareholders through dividends and share buybacks. We believe that the opportunity came about because of three core components. And these were, if we look at these three, and as we do on this slide, we highlight the fact that these coming together created the opportunity to invest in Japan in a way that hadn't been the case before. And it was in this order, really, that I believe that we identified these opportunities. The first was cash flow, and I'll go into each of these in slightly more detail on the following slides. But cash flow, not just the amount that companies were generating, which has come and is steadily increasing because improvements in corporate capital efficiency and operating measures, but also how that was being allocated. The second is valuation. And this is key because for many years post the bubble in Japan, equities were trading at multiples that were at substantial premiums to the global peer group. And it wasn't until the aftermath of the global financial crisis, so really the period 2011, 2012, that for the first time I was able to look at stocks listed in Japan and find that their valuations were either comparable or in many cases at a discount to the global peer group. And that effectively defined a new ground zero for investing in Japan, this sort of valuation derating. And then finally, governance. This is an extremely important driver to what we have seen over the last 10 years. But as we'll go on to discuss, we feel that the opportunity that this is creating is actually even more exciting now than it was even as far back as 2012, 2013. So starting with cash flow, there are two very, very important charts here. There are lots of information that we could talk about just on these two particular charts, but it really defines what we see as the important driver for investors in considering Japanese equities. The first chart on the left-hand side is cash flow, just an analysis of cash flow. So that's dark blue line, which is cash flow generated by the corporate sector, and the light blue line, which is cash flow spent. And Japan experienced what is called the Japanese economic miracle, the very strong recovery, economic recovery post the Second World War that lasted for decades, so the 60s, 70s, through the bubble period of the 80s. And actually even during the 90s, you can see there was a very, very tight correlation between cash flow generated and cash flow spent. This was because of a very sort of tight relationship, I think, between the private sector and public sector, and resulted in companies spending all of the cash that they generated. Actually, even in the bubble, as you can see, they were spending more than they were generating. And it wasn't until the aftermath of the Asian crisis and then the tech crash, so 98 and 2000, that I think Japan finally began to acknowledge or recognize some of the problems that this had created. You can see that corporate behavior changed very dramatically because these two lines diverge quite notably. And really what happened was a number of shocks to the corporate sector that resulted in this change of behavior. So we had bankruptcies across parts of the economy that we'd never seen before: securities companies, life assurance companies, construction companies. This led to problems in the banking sector and ultimately the nationalization of the banking industry in the early part of this century. And companies were forced to behave in a very different manner, as these two lines diverging indicates. There was a need to write off all of the impaired assets that had been accumulated in the years prior, particularly in the bubble period. Companies fearful of the banking sector, started to pay down excessive levels of debt. But also, if you look at the chart on the right-hand side, you can see that a portion of this now surplus cash flow started to come back to shareholders in the form of dividends and share buybacks. And that's what has been key. The chart looks increasingly attractive as time goes by, going very strongly from bottom left to top right, and particularly in the period that we've mentioned, really from around about 2012, 2013, the chart looks very, very compelling. And actually, dividend growth in Japan has been far superior to other markets over this time frame. And I think that's a very, very important characteristic to be aware of, particularly when we go on to discuss the further opportunity that we see. But really, I think it's these two charts. You can see the input to what we're talking about, which is the cash flow generation, and from an investor perspective, the output, which is a very, very strong profile of returns through dividends and share buybacks. The opportunity, we feel, continues to improve. Just looking at this fairly simplistically, if you look at the spread between the cash flow generated and cash flow reinvested or cash flow invested, you can see that is continuing to expand. So certainly the opportunity going forward for further increased returns is very, very clear. The second component I mentioned is valuation. And I did allude to the fact that equities in Japan traded at very, very significant premiums. If you go back to the peak of the bubble, I think the equity market was trading on an almost 3-digit multiple, so almost 100 times earnings. When I first started covering in Japan in '97, it was still on about 65 times earnings. People used to try and justify why that was the case, but the reality has been very, very clear that it wasn't until valuations in Japan normalized and hit levels that were comparable to international markets that really Japan had the opportunity to outperform. That value normalization occurred in 2012, 2013, as this chart indicates. And actually, even though the performance of the market has been very, very strong, the valuation, certainly on a price to earnings multiple, is only comparable to what it was then. And as a result, Japan has actually fallen to a fairly significant discount to the global peer group, despite the fact that we feel the underlying fundamentals of the Japanese equity market have improved considerably. So just giving you some example, the ROE of the market in 2013 was only 6%. The equity dividend yield was only 2%. Now, if you look at the ROE, it's above 9% and trending further higher. The yield of the market is 2.6, but actually looking at the run rate of share buybacks this year, year to date, we would see that the actually combined return to shareholders this year of dividends and share buybacks is well above 5, which is superior to either the US or the UK. So we feel that the valuation discount does not reflect these underlying improvements that we are very, very confident about. Finally, on governance, this has been the driving force for the improvement. And the real purpose of talking about this is really comes from an understanding of the desire in Japan to see improvement and how much of a coordinated initiative this is. So if we go back to 2012, 2013, I think the real impetus for what we're seeing in Japan was the was government initiative that resulted in something called the Ito Review, looking at the competitiveness of corporate Japan. To say this was a government-sponsored report, which I believe, and having read it, is quite damning of where companies were and the direction they were taking at that particular point in time. And as a result of that, there have been some fairly significant changes that continue even to today that we believe are very, very significant for corporate Japan as a whole, but also for investors looking at Japan. I say it's coordinated because we started with the government, with the Ministry of Economy, Trade and Industry, METI. But this was followed by the Financial Services Agency, issuing a corporate governance code and stewardship code, which are modelled very much on the ones we have here in the UK. Which basically have redefined the relationship between shareholders and corporate management in a very, very positive way. More recently, we've had the likes of the Tokyo Stock Exchange announce a very significant reform and initiative to basically force companies to become much more shareholder focused, to raise awareness of cost of capital in their business, improve quality of corporate governance, and improve corporate value. And this has been a very much an accelerant to these changes that we have been seeing over the last 10 years, and see very much on an individual company basis. So we highlight that on this next slide. This is one of the companies we hold in the portfolio, and this has been their response to the Tokyo Stock Exchange initiative, and how they're looking to enhance the performance of their business from an operating perspective, but also from an investment perspective as well. And this sort of slide or presentation material is becoming very, very common in all the meetings that we have. And the key here is the fact that if you look at the way that companies are addressing this, it's very, very similar from our starting point: cash flow, valuation, and governance. So we believe there's a very strong consistency between what companies are now doing and the direction that they're taking, and how we have been investing and continue to invest. The process, I'll run through this fairly quickly and maybe then talk about a few examples which I think make it much, much clearer. But the process is focused very much on those three characteristics, or those three fundamentals: cash flow, valuation, and governance. And when we see all of those, all the criteria we have for those met, then we are able to invest. And as I say, it's a very, very concentrated portfolio. There are over 4,000 companies listed in Japan. That is in stark contrast to the US, where the number in Japan has risen quite significantly over the last few years, which is in stark contrast to what we've seen in the US, where numbers have fallen. And that's led to a lot of inefficiencies, and some of the questions that are raised by investors, and now more recently by the Tokyo Stock Exchange, about why some of these companies are listed. And as a result, we are seeing changes in that regard. However, currently there are about 4,000. We believe, as I mentioned earlier, that there are many opportunities right across the market cap spectrum. So we start with that universe. We are able to screen quite easily, I think, for the characteristics that we look for, based on fairly minimum criteria that help define our investment universe. And from this particular point is where we spend a lot of time really doing the desk-based research that brings that down to an investable list of companies that we keep a much, much closer eye on. Companies that we believe are potential candidates for the portfolio in the future, or companies where potentially we see the opportunity through engagement to improve the performance of the company. Some of those are kept very much on the short list, so the amount of work can vary on where we feel the company is in its opportunity path. But having done that, we have a very tight short list of companies that we see are a strong list of candidates to replace current holdings in the portfolio. So very, very quick run through of the process. The portfolio construction focus very much here on dividend growth. The characteristics that I mentioned we are looking for in companies are companies that are in growth phase, so in industries that are growing, have strong market positions in those industries, and where we see strong evidence that they are able to continue to deliver growth through reinvestment from their own financial resources, but are able to distribute or complement that growth with this distribution to shareholders through dividends and share buybacks. We do see there are other companies in different phases of their evolution, I suppose, in this regard. So stable yield and special situations. These are companies that ultimately we intend or believe will move into that dividend growth category. Stable yield are companies that have or are encountering maybe tougher operating conditions or operating headwinds at the moment due to economic cycle or in a product cycle, technology cycle, whatever it may be. But we're very, very confident that the company, because of the relationship that we have and the meetings we have with management, are able to at least maintain, if not in many cases, continue to grow their returns to shareholders, even though they are facing the short-term or facing these short-term issues. And we believe where those returns are high enough, then we will be rewarded for our patience through the receipt of a very, very high dividend yield, and with the prospect of strong returns coming as growth returns. And we have a number of examples in the portfolio from historically where we've been able to do that, invest in companies that, high quality companies that arguably have fallen out of favor in the short term. But we are very, very confident and have been very, very confident that these companies will continue to grow. The second is special situation. This is another category we have within the portfolio that we believe allows us to capture some of the changing dynamics of companies, either in terms of business changes or importantly in terms of the corporate governance changes, and really allows us or reflects the fact that we do see a significant amount of change taking place within the corporate world in Japan. So maybe just bringing it to light a little, maybe I'll talk about a couple of stocks that we own that we have here, and maybe just to broaden it out as well, another company that we own which we haven't got the charts for, but I think it's just quite an interesting example. So the first is Shin-Etsu Chemical, not necessarily a brand that people will recognize, but a very, very important brand globally in the technology cycle. Shin-Etsu is a world-class manufacturer of a number of key products in the production of technology. It's the world's leading manufacturer of silicon wafers. It's the world leading manufacturer of components in the manufacturing process, photoresist photomasks. It's also the world's leading manufacturer of PVC, predominantly in the US. So it's very much an international company. It has spent the last 25, 30 years investing predominantly overseas, establishing these very, very strong positions. And as a result, generates amongst the highest, if not the highest margin of all chemical companies globally. It's a company that has been evolving with regard to its sort of corporate governance and shareholder return in particular. Management, I think, was dominated by an elderly founder who, and then this really is a good example actually of how generation change is helping this evolution within Japan, but was very reluctant. The former founder was very reluctant to sort of maybe embrace the idea of minority shareholders and understanding their requirements. So the company spent many years hoarding cash, paying a dividend, only a very modest dividend that was very, very volatile because it reflected the reported earnings of a company in any one particular year, not necessarily even just the operating earnings, but if there were any exceptionals in there, it also reflected that. But the situation has changed, the environment in Japan has changed, management has changed, and we start to see the benefit of that. The charts here show the opportunity. The cash flow remains very, very strong. That's the chart on the top right. The company's one consequence of that very, very strong cash flow over a very long period of time is the net cash position that has been built up over very many years, which we indicate there on the bottom right. But more recently, the company has introduced a much more attractive shareholder return policy, which has emphasized a degree of stability in years where things might be tougher, so where there may be structural headwinds, but also a commitment to increase this progressively over time. We're starting to see the benefit of that. One thing that we will talk about and can talk about for Shin-Etsu, and also with this, the second example I'll talk about, is how companies have been managing an inventory cycle as we've come through what is a rather unusual period. Firstly, COVID, and then the supply chain issues that followed. And as a result, earnings growth has not been quite as strong as we believe the underlying market, but the company has been able to deliver good returns over that time frame, and we believe will continue to do so going forward. The second example I'll talk about is Hamamatsu Photonics. A reason I'll talk about this one is it's a fairly recent addition to the portfolio, and I think is very representative of the opportunities that we believe are evident in Japan at the moment, and also evidence of our sort of patience in the approach that we have. So Hamamatsu Photonics, photonics is the science of light, and Hamamatsu Photonics is a world leader and has been for a very long time. Its products have been cited in 3 times by Nobel Prize winners in the last 20 years for their importance in the research work that those individuals or those institutes have been undertaking. It has a very, very dominant position in quite a number of areas. This company also experienced a very unusual inventory cycle during COVID. Its products are used in X-ray machines, it's used in product testing, and demand was very strong in the early part of the pandemic. And we can see that actually in how the valuation on the top right expanded quite notably. So demand was very, very strong. Obviously, it's clear in hindsight to everyone now that there was a lot of over-ordering and expectation maybe in the years that followed with supply chain issues that there may be shortage or issues in delivery, so companies continue to over-order. And maybe, I think in some cases, certainly when talking to the company, a belief amongst some of their clients that the recovery in China would be much stronger than it has been. And as a result of that, there has been an inventory issue that the company has been working through for the last two years. And as a result of that, you can see how valuations have dropped. Very, very important for us when looking at investment opportunities. But also with the introduction of new management, we've seen a very notable change in the company's approach to shareholders. The company are now fully committed to stability of dividend and the progressive growth that we are looking for. The profile there you see on the right-hand side, strong cash flow, company that's accumulated net cash on its balance sheet. The reason for the fall there you see over the last 2 years is some very, very prudent acquisitions they've made overseas, particularly a larger acquisition in Europe that we think enhances the growth opportunities longer term. But also they've been buying back shares. So the company fits the profile and has done for a long time in terms of sort of quality of company, cash flow generation. But it wasn't until we were able to tick the other 2 boxes, valuation and governance, that we felt confident enough to invest. I will mention one other company because I realise that the examples we have in the presentation are on the whole companies that are international, very, very strong internationally. One of the longer holdings in the portfolio is a company called Nippon Parking Development. And I think this is very interesting for reasons. If I go back to those original charts that I said we could talk about for a long period of time, one other aspect of what we're seeing at Japan at the moment is an unwind of all of the assets that were accumulated during the 80s and 90s, so during the bubble period. This is very important because it's part of the improvement in capital efficiency that is driving share prices in Japan currently higher. So if I go back to the 80s and 90s, it was not unusual for companies in Japan to own their own golf courses, to own their own ski resorts, to own lots of peripheral assets. I wasn't in Japan during that time, but I've heard lots of stories about how crazy it was during the bubble, and certainly we see evidence of that now, with companies beginning to shed some of these peripheral assets, say golf courses, ski resorts, buildings, and other sort of assets that accumulated at that point in time. Nippon Parking is a company that was established about 25 years ago with the purpose of utilizing assets more efficiently. That's its business mantra. It has done that very, very successfully in parking services, as its name suggests. It's a company that manages car park facilities in large buildings, so office buildings, in hospitals, and other facilities across Japan on a monthly basis. So cash flow has been very, very stable, and that allowed the company to continue to improve its returns to shareholders very, very notably, even during the pandemic, where actually demand for parking itself had fallen. But over the recent years as well, it has also been identifying opportunities to invest in some of these peripheral assets that are being shed by the large corporates in Japan, and it has established quite a strong position by buying ski resorts from the likes of conglomerates in Japan, managing those on a much more professional basis. So doing simple things like offering simple single ski passes, so not taking away the need to have different ski passes for different lifts. It's been investing in upgrading of those, and as a result of that, has been generating a very, very high return on the assets that it acquired very, very cheaply. And that has been a long-term holding in the portfolio. It's performed very well. We still see very, very significant opportunity for that company to continue to grow with the changes we are seeing in Japan at the moment. So that is a purely domestic company. I've spoken about a number of companies that are very strong internationally. Nippon Parking Development is a purely domestic business that we feel reflects some of the opportunities that we see in the domestic market, even though the well-known dynamic of falling Japanese population creates headwinds for some segments of the market, some industries in Japan. We still see some very attractive opportunities to invest in the domestic market. So if I look at the portfolio as a whole, what are you getting? Well, you can see on this slide the breakdown by market cap on the bottom right. So as I mentioned, we are all cap in our approach. There are lots of very, very attractive mid and small cap companies in Japan with very, very strong market positions. It's a market that is very, very inefficient because our coverage of the market is very sparse, particularly as you move down the market cap spectrum. And as a result of those inefficiencies, they create these opportunities to generate alpha. I've indicated that we have a portfolio or portfolio construction that emphasizes dividend growth. So our starting point for investing really is to look to buy companies where we can buy and hold, benefit from the growth of the business, but benefit also from the compounding effect of rising dividends in particular. And if we look at the aggregate statistics for the portfolio, you'll see that we have a very, very high quality portfolio. If you look at it in terms of measurement of return on equity, for example, at a market multiple of price to earnings multiple comparable to that of the market. And if you look at other measures like operating profit margin, etc., you can see there is strong evidence there of the quality of the overall portfolio. But very, very importantly, and this is one of the objectives of the strategy and the trust, is that we're able to offer a dividend that is superior to the underlying market. If I look at the performance, what we are pleased about particularly is the fact that it has been consistent and really reflects the starting point, the importance of those three key foundations that we have: cash flow, valuation, and governance. We believe by focusing on those, we've been able to generate a consistency of performance over time throughout different phases of the market. If we go back to that period there from 2015 to 2019, it was very much a growth market in Japan, and the strategy performed very well. If we look at the period post-COVID, so from the end of 2019, 2020, the market's been very much in a value, has had very much a value focus, and yet the strategy has performed very well. So we feel this focus that we have on the particular attributes is very, very important and leads to long-term opportunities. Maybe I will leave the presentation there and open up to any questions if that's an appropriate time.
Yeah, Richard, well, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions. You can do so just by using the Q&A tab that's situated on the top right corner of your screen. We have received a number of questions, both pre-submitted and throughout today's live presentation. And I want to start off the Q&A session here with the first question, which reads as follows. Presumably, if the yen strengthens, then dividends in sterling will increase. Do you see the yen strengthening against the pound over the next year?
Yes. Your assumption is right. If the yen strengthens, then the dividend accumulated in sterling increases, and that was evident when sterling fell, for example, in 2016. Since then, the yen has weakened, and that's obviously been a slight headwind in terms of the GBP distribution of dividends. But actually, as we can show, actually the dividend has continued to grow sequentially over that time frame, based on the strength of the underlying returns coming through from individual companies. But the currency is a consideration for the trust and the board, certainly when they are announcing the dividend, and it's important that we look forward and discuss the potential moves as we see them. And for a long time, we have been expecting the yen to strengthen. If we go back to the beginning of 2023, for example, when Japan finally relaxed the last restrictions of its pandemic period, at a time when expectations in the US were more about recession than anything else, and how quickly interest rates in the US would be cut. Then from that point in time, we believed that there was a very, very strong case for the yen to start strengthening. As it turned out, the US continued to power ahead. US rates continued to move higher and have remained very high, or relatively high, since. But since Japan and the Bank of Japan governor has made it very, very clear that he's looking to normalize monetary policy in Japan, that seems to have put a limit on the yen weakness. And if we look forward from here, certainly there is a strong expectation that monetary policy in Japan will continue to tighten. So, the direction still within inflation in Japan is still trending upwards. So I think that sort of confirms that view. And secondly, the other component is interest rates in the US. And we will wait to see. I think there's a strong expectation that rates in the US will come down at some point, and the upshot of those two moving dynamics would be a further strengthening of the yen.
Perfect, that's great. Turning to the next question, are rising dividends and buybacks in Japan a lasting trend or a short-term response?
We feel very, very confident in saying that it's a lasting trend. if I look at each of these components, the cash flow, valuation, and governance, probably the cash flow and the governance are the key ones in this particular question and response to this particular question, but very, very confident that these are both moving in the right direction, that support further growth of each. In fact, if anything, the opportunity now is far more exciting than it was when we established in 2013. As I mentioned, the amount of cash flow being generated continues to expand. That's a consequence of better capital efficiency, better operating performance. Operating profit margins in Japan have been expanding. That's supporting the cash flow. Also, the unwind of those surplus assets that I've alluded to, sell down of cross shareholdings is boosting cash flow. So there is very, very strong support. And if you look at the payout ratio in Japan, it is still very, very low compared to international markets. So I think the aggregate payout or distribution from annual cash flow has edged up. It's around about 35%. But it's still very, very low when you compare that to other markets of the world. So dividend cover in Japan is very, very high. And that's the reason why even during the pandemic, the profile of dividends in Japan were very much more robust than they were in other markets. And tied in with that, the ability for companies to pay more, you are getting this improved willingness of companies to pay more, and that comes from the governance argument. As I say, it's a very, very coordinated approach. You have governance support, we have the support of the FSA, we have support of the Tokyo Stock Exchange. And it's really one of the very, very exciting considerations for Japan, I think, at the moment. Everything is very, very coordinated. We can call it Abenomics. I think many components of Abenomics were actually in place in years before the former Prime Minister Abe came to power. But it is very, very coordinated, very, very consistent. And you could argue that's very, very different. Policy is very, very consistent in Japan with clear objectives that is very, very different to what we're seeing in other economies around the world at the moment.
That's great. Thank you, Richard. Another question we have here. How is the trust navigating the rise in buyouts and privatizations like TechnoPro?
Right, yeah. I mean, part of the initiative of the Tokyo Stock Exchange is to make the index in Japan more investable. And it's very much a sort of carrot and stick approach. It's encouraging companies to behave in a certain manner and threatening companies with the risk of delisting if they don't conform in the long run. And some companies are making a choice that actually the direction is not one that they want to operate. And that in itself is quite interesting. There are some companies that don't like the short-termism of certainly, certain types of investors and things that they are being forced to do or potentially forced to do as a result, and are taking the view that they would be better managed for the long run by becoming private. And that's a very, very notable trend in the market. Probably by far and away the largest is the Toyota Group, or the Toyota family, the founding family of the Toyota Group, looking to take the founding business of the Toyota empire, Toyota Industries, private. And I saw Toyota Industries 2 weeks ago when I was in Japan. And I think the reason that they will take this path is that they believe that by distributing too much in the short term undermines their ability to grow in the long run, and therefore feel that they are better served, and their business and their employees and everyone in general will be better served by the company taking itself private. And there are one or two companies in the portfolio where we have seen moves in this direction. It's certainly rumoured that TechnoPro will be taking itself private. It's yet to be confirmed. But again, having spoken to the company, I can see that there are very, very strong reasons why they might choose to do that, while their business goes through a fairly significant sort of transition away from being a employee dispatcher, so an engineering dispatcher, to becoming a sort of consulting system integration company. It feels it will be better able to do that away from the glare of the stock market. And that might lead to it becoming a private company or an unlisted company.
Thank you for that, Richard. We've got an investor here who highlights the importance of income to many investors and asks if the trust could potentially move to quarterly dividend distributions.
I'm going to say sort of no. Ultimately, the decision isn't mine. It belongs with the board. But I would say that it's hard to do that in Japan at the moment because companies distribute only twice a year. And the dividend distribution from the trust is very much in tandem with that. So ultimately, it's a decision for the board. But I think the reason that we do, or the board do what they do, or have done up to this stage, is it's very, very consistent with the flow of income we receive from the underlying investments.
Understood. Thank you, Richard. The next question we have here: what structural or macro factors currently differentiate Japan from other developed markets in terms of income and capital growth opportunities?
Yeah, certainly in terms of this sort of income opportunity, it's the fact really companies haven't done it before. If you look back at look at this chart again on the right hand side, you can see that during this economic miracle of Japan, companies didn't pay or paid very little attention to shareholders. It was almost like a sort of cursory sort of income distribution that didn't rise. And as a result of that, you could argue that shareholders now are benefiting from the fact that shareholders for decades didn't really, or minority shareholders didn't benefit properly. So I think that's really what differentiates Japan in this regard at the moment compared to other markets. Companies have not been pushing the boundaries on distribution as maybe companies elsewhere in the world have done. They're very financially secure, and for historical reasons, coming through that period that incorporated their own domestic bubble, maybe the Asian crisis, the tech crash. The fact that a lot of companies in Japan will tell you that they, as a nation, it's prone to natural disasters. So there's a desire to maintain financial robustness, and we see it in the general behaviour, the general culture of Japan. During periods of stress, companies want to continue to be able to pay their suppliers. They want to continue to be able to pay their employees. So they have a very, very different mindset, I think, to the way that Western companies have approached things over years. There's very, very few examples of companies, for example, that are using debt as a way to finance dividends or share buybacks. Everything that we see here has come from sort of cash flow, either cash flow generated, as the chart on the left-hand side shows, or cash flow that has been residing on balance sheet or near cash. So either cash, pure cash that has been accumulated on the balance sheet, or maybe cash that's been generated by the sale down of cross shareholdings. That puts Japan in a very, very different phase of this development of shareholder return than any other market. And it's why the dividend profile has been much, much stronger over the last 10, 12 years than other markets.
That's great. Thank you, Richard. Another question here from investor. Have you any thoughts to offer on the aging and reducing population of Japan in relation to the trust's future?
Yeah. I mean, there are many ways of discussing this. It's a headwind for domestically focused companies, but it's not anything new. I mean, the first day I started covering Japan in '97, I was told the Japanese population was going to decline. It actually didn't start declining until around about 2015, and it's clear that the Japanese government have been very, very clear in the future dynamics of the domestic population, and as a result of that, everyone in Japan knows what's going on, not least corporate leaders. And that's why we have seen the likes of Shin-Etsu Chemical invest in the way that they have for decades. And that is reflected in the structure of the equity market. The equity market has a very, very different structure to the in terms of exposure to international markets compared to the domestic economy. And therefore, you can't necessarily just tie the two together. You can't. I think it's wrong to ignore the Japanese equity market just because of a view on the domestic Japanese population. There are areas that I think will be difficult and are difficult areas to invest, certainly with that population dynamic. So certainly if you're a solely domestic company, arguably your consumer base will fall and will continue to fall going forward. And those tend to be areas of the market that we seek to avoid. So growth being very, very important for us means that there are segments of the market that we feel are directly exposed to those dynamics of the population in areas that we choose not to invest. There are still opportunities to invest in the domestic market. There are changing dynamics. The aging population creates particular opportunities maybe in areas such as healthcare, although in terms of the portfolio currently, we don't have a huge amount of exposure there because I find that valuations are somewhat prohibitive. But there are opportunities in terms of technological change or investment that companies are making. One example of a company that we own that is a very good example of that is company Zozo. It was also one of the examples in the slides here. But Zozo is Japan's leading or only online fashion retailer. And despite the fact that Japan is very, very technologically advanced, the speed at which e-commerce has penetrated the market has been very, very slow in comparison to other regions. Again, that's for cultural reasons as much as anything else. But the opportunity is still there. Zozo has demonstrated that and continues to do so. And we believe there is now, despite maybe the longer term population challenges that the country faces, there is still opportunity for that company to grow quite considerably. So, excuse me. Yes, we do. We are very aware of the population dynamics in Japan, and that certainly features in our analysis when we are looking at individual companies and considering their opportunities in the long run.
That's great. Thank you, Richard. And we've got one final question before we'll wrap up. Please, can you provide an example of portfolio holding that is disappointing and potentially your thought process around it?
Yeah. It is a concentrated portfolio where we find there are companies that aren't delivering in the manner that we expect. We do have the opportunity to change that holding. And there have been examples that haven't delivered in the manner that we had expected. That can be for either of any of those core reasons. Cash flow would come about because of potentially disappointing operating performance, or maybe reallocation of cash flow, maybe less focus on, or less than expected focus on shareholder return, greater focus on investment or making an acquisition. Valuations can change. Sometimes individual stocks don't get fully recognized in the manner that we expect, and we've seen stocks that maybe suffer a valuation derating, or there are situations where maybe governance isn't quite as we expect. So there are lots of reasons why things can be disappointing, and it's not a case in each and every example of us giving up immediately, if that's the right term. Certainly, if those characteristics are strong enough, we believe that the investment opportunity will deliver in the long run. Thinking back to 2024, there was a particular stock that had become much harder, I think, for us to justify continuing to own. That's a company called DIP. It's a company we first invested in 2020, I think, 2019 to 2020. It's Japan's leading online job recruitment business, and had performed very, very strongly, and certainly but had fallen very sharply as we entered the pandemic. Fear that at that stage, obviously, were very different from the reality as it turned out. But obviously, in the early part of the pandemic, recruitment of employees dropped quite sharply. That created the opportunity for us. We established a position in a company that reacted to those changes in a very, very positive manner from our mind in terms of the governance. So immediately offered a greater stability on its shareholder return, which gave us the confidence to invest. And that initially was a very, very strong performer in the portfolio. However, despite the fact that the population dynamics are as they are, and there is a very notable job shortage in Japan, the job recruitment business and the job recruitment industry in Japan has not been as strongly performing as we might have expected. And the reason for that is actually job mobility has gone up. And actually one of the greater, well, rather perversely, I suppose, one of the greatest casualties of that is actually the recruitment industry itself. It's seeing a very, very high turnover of staff, and that's created problems in that business that ultimately led to us reassessing that position and selling. So that's an example where we chose to move on. Actually, today we've had a stock, a company called Carter Holdings, which is a company we've also held for a long time. That's actually been subject to not a privatization, but a partnership and alliance with a larger company. So, where we feel that valuations are still very, very compelling, as in the case of Carter, we will continue to own the stock if we see that there is an opportunity for that value to be realised.
Perfect. Well, Richard, thank you very much for answering those questions from investors. Of course, the company can review the questions submitted today, and we will publish the responses out on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, particularly important to yourself, Richard, could I just ask you for a few closing comments?
Great. Yeah. Well, thank you everyone for your interest, and thank you very much for the questions. It does seem like a particularly exciting time in Japan. As I mentioned earlier, I was there 2 weeks ago, and on a fairly intense schedule of meeting companies, and number of things that stand out to me. One very much is the long-term, the benefits of sort of long-term approach are very clear, both from an economic standpoint, policy that we've alluded to, but also very, very evident in companies. It's still an evolving opportunity. In some media reports, it sounds as if this sort of transition to improved governance is overnight, but actually, if you look at the chart and been looking at some of the factors we have, you can see that it's been 10, 12 years in the making. And over that time, there's very, very clear and strong evidence that companies are fully committed to that. The chart goes bottom left, top right, and looks very, very strong in that. But the one thing that was very, very clear to me from meeting the companies is that there's a level of confidence and ambition in companies that really hasn't been quite as evident over the 28 years I've been covering Japanese equities. So that for me is very, very exciting. I mean, to be covering a market for that period of time and finding it more exciting now tells you, I think, quite a lot about what is going on in Japan at this particular time. So I hope that encourages people to maybe reassess Japan. Certainly, anyone who's still tainted by experiences of 15, 20 years ago, I think will see something very, very different in Japan if they look at it now.
Well, Richard, just like to thank you for updating investors today. You've been very generous with your time. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CC Japan Income and Growth Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.